What if putting less down could actually make you richer? I know, it sounds backwards, right? But in 2025, with rising prices and smarter loan options, that old 20% down rule could actually be holding you back. Here's the truth. Waiting to save 20% could cost you far more than buying sooner. Home values and rent keep rising. And while you're saving, the market isn't waiting for you. So today, we're breaking down the real math behind 20% down versus 3% down. Because what seems safe might not be what's actually smarter. Before we jump in, don't forget to hit that subscribe button and tap the bell. I drop new videos every Monday, Wednesdays, and Saturdays right here on the Mortgage Cafe with Angelica, where I serve you a fresh sip of wisdom on everything mortgages and real estate. I'm Angelica Obregon with Key Mortgages, your local loan officer. Let's take a closer look at how less can actually mean more when it comes to your down payment strategy. Let's start with a simple example. $500,000 home, 20% down of that is $100,000. 3% down is $15,000. 20% down buyers get around 6%, while the 3% down buyers get around 6.25%, plus $240 for your monthly PMI. At first glance, that 3% down loan costs around $89,000 more in interest and PMI over 10 years. But that's not the whole story, because what you do with the $85,000 you didn't put down can completely flip the math. If that $85,000 is invested, it could double over 10 years to about $170,000. When you factor that in, the 3% down buyers end up only about $4,000 more expensive overall, and keeps liquidity, flexibility, and opportunity. Looking only at monthly payments ignores the bigger financial picture. Wealth isn't just about what you spend, it's about what you keep growing. If you learned something new so far, hit that like button, subscribe, and comment below. It helps me reach more buyers and agents who need this information. Now, let's be fair. There are great reasons to put 20% down. The mortgage insurance is gone, there's lower monthly payments, there's better interest rates, more equity, and easier resale flexibility. But it comes with trade-offs, and those trade-offs matter. So with 20% down, there's huge upfront cash requirement, or your liquidity is tied up in the home. It can wipe out your emergency savings and takes years to save while home prices keep rising. You might be protecting yourself for PMI, but also missing out on appreciation and opportunity. Now, on the flip side, going with 3 or 5% down, it gives you faster path to home ownership, cash left over to invest or keep for emergencies, early access to home appreciation, flexibility to pay extra or refinance later. For a lot of buyers, that flexibility is the real wealth builder. Now, of course, with the minimum payments, there's a risk. So higher payments with your PMI, less equity buffer if you sell early, possible higher interest rate requires stronger financial discipline. If you're impulsive with money or already maxed out, minimum down payment might not be the move. Here's the part that shocks most people. Saving $85,000 at $2,000 per month, it takes about 3.5 years. Meanwhile, with just 4% annual appreciation, that $500,000 home becomes $573,000. So your future 20% down covers only about 17%, not 20% anymore. You spend years saving, but the goalposts moved. Waiting often makes buying harder, not easier. Putting more down is smart when you have strong reserves after closing, a lower monthly payment is your top priority, the market isn't appreciating rapidly, you prefer stability and want to stay long-term. Minimum down payment might be better when 20% will drain your savings completely. You can invest the difference for higher returns. Prices are rising quickly. You value speed and flexibility. Here are some key factors to remember. PMI isn't forever. It can be removed at 20% equity or auto-canceled at 22% equity. Rates can be refinanced. So less down today doesn't lock you in forever. And in appreciating market, early buyers often win by getting in sooner. The bottom line, 20% isn't a one-size-fits-all anymore rule. In many scenarios, putting less down and investing smartly can actually lead to more wealth over time. Your best choice depends on your goals, your cash flow, and your market. So if you're looking to buy in Georgia or Florida, I'm your girl. I'd love to help you with your mortgage journey. This is Angelica with Key Mortgages. I'll see you on the next video.